problem is the consumer still spent more than he earned, and the consumer spent more on necessities, right? All this spending, and it was 110 billion in spending increase. None of it went to eating and drinking establishments. Sales fell. Revolving credit now on a rolling 12-month basis is deflating. All right. There's only two other times we've seen that: 2008, 2009, global financial crisis, 2020 pandemic, and now. All right. And then you start to look at the consumer credit dynamic, where even consumer credit is kind of deflating. We have revolving credit deflating. You have eating and drinking establishment sales now year over year at the below the rate of inflation, which the retail sales don't include inflation. So basically, you can see that too. When you're not going out eating and drinking, especially when McDonald's tells you we're cutting our menu items because we have less foot traffic and we need to maintain our margins. Wow. Doesn't that speak volumes? When you're talking about people are going even to McDonald's less, which is the last gas place you might go to have a little bit of feel-good factor. There isn't that. And all the Fed's surveys of consumers show this too. New York Fed survey is a treasure trove of information, comes out every month. What it's showing us is now even the highest income level is expecting their income to grow less than inflation at a rate lower than inflation. Real income deflating even at the top level, let alone at the bottom part of the ladder of income, where you're talking 2 to 2.5% real deflation in income. So you can't support spending at the same time when credit card debt's greater than savings, the highest ever, borrowed at the highest interest rates ever, and delinquency rates are back to the second highest level in history, the last time we saw them here in 2008, 2009. So the Fed will be forced to cut rates to support the consumer, to support the housing market, to support the labor market. The only reason the unemployment rate hasn't risen is because more people are dropping out than are finding jobs. Okay, so this is a problem. It's just a secular structural issue here with the labor market. So, and you still see even with this, wages relative to inflation below 1%, pretty much across the board. So you have a choking consumer, you have a housing market in crisis, you have a labor market that's not as strong as everyone says it is, and the Fed is still restrictive. So they could easily come down to 3.5 just to get neutral against the 3% inflation. If they wait too long and inflation starts to rise, it's going to make it much more difficult for them to do what they probably should be doing right now. And if Powell is playing this off because of tariffs, he does have this out. It's a legitimate out for him, but you get the sense that this is more, that this is kind of mano a mano. He's not going to flinch until September. And Fed Governor Waller said, if we wait till September, it'll be too late. And he said these exact words, which I've been saying almost all year long: we'll be behind the curve. And the Fed is.
Always a pleasure to get a chance to talk with Greg Weldon, Weldon Online. Greg, first of all, appreciate you taking the time. Always a big list of things. And I might just say, I've always described Greg as the person other analysts read. Why? Because it's in-depth, it's across the world, factors influencing in so many ways. Greg, let me just start with, I just got to throw stuff at you left field, but let me start with the U.S. and the impact of, let's call it the ongoing battle between President Trump and the Federal Reserve. Is it as simple as saying we are going to get lower rates because President Trump wants them? But what does that mean? Just give me your quick take on that.
Yeah, it's as simple as to say we are going to get lower interest rates, but not because Donald Trump wants them, because it's what's needed. It's where we should have been probably already. I don't like to criticize the Fed. It's the hardest job in the world. You couldn't pay me enough money to do this job. But having said that, okay, the reality is since 2018, Jerome Powell, he's been a great Fed governor in the sense that he laid out his whole plan, 311 pages of white papers, that they published in 2018 when he took over about the new monetary policy paradigm. Let inflation run. We'll lift interest rates. We'll use the Volcker playbook and bring it back down. Problem is the Volcker playbook didn't include $36 trillion in public debt, another $18 trillion in household debt, $55 trillion in total U.S. debt, just from that one little perspective, let alone all the uncounted debt out there. So in that context, he has been behind the curve at every turning point, Mike. And to when he had to cut rates, to when he had to raise rates, to when he cut rates. Remember, inflation was, we were waiting for Godot because they were never going to get inflation. And then you said we're going to get inflation, and then it came, and then you were waiting for them to maybe do something about it, and they didn't. So he's behind the curve here, and here's why: because inflation and any metric and the headline numbers that they use as a potential measurement or target rate is 3% or maybe even a little bit lower. Okay, the Fed funds rate of 4.25 to 4.5 is now somewhat punitively tight. It's a tight, restrictive policy. Plus, you have $535 billion still in QT on a rolling 12-month basis in the shrinkage of the balance sheet. Now, that will roll off, but it's still there. All right. And even though they've said, we're going to let it roll off by less now, it's still there. It's still a tightening factor. In the meantime, you have a housing market that's in crisis. You have a consumer that's cocooning, right? And these guys that come on TV who are stock market bulls because everyone has a vested interest in seeing the stock market go up when they're on TV, right? They continue to say the consumer is strong and the labor market is strong. Nothing's further from the truth. And when you talk about the consumer, we're talking about, even though you had for the first strong sign I've seen all year in the consumer was a rise in wages and salaries and disposable income in the PCE numbers we got Friday. Okay. The problem is the consumer still spent more than he earned, and the consumer spent more on necessities, right? All this spending, and it was 110 billion in spending increase. None of it went to eating and drinking establishments. Sales fell. Revolving credit now on a rolling 12-month basis is deflating. All right. There's only two other times we've seen that: 2008, 2009, global financial crisis, 2020 pandemic, and now. All right. And then you start to look at the consumer credit dynamic, where even consumer credit is kind of deflating. We have revolving credit deflating. You have eating and drinking establishment sales now year over year at below the rate of inflation, which the retail sales don't include inflation. So basically, you can see that too. When you're not going out eating and drinking, especially when McDonald's tells you we're cutting our menu items because we have less foot traffic and we need to maintain our margins. Wow. Doesn't that speak volumes? When you talk about people are going even to McDonald's list, which is the last gas place you might go to have a little bit of feel-good factor. There isn't that. And all the Fed's surveys of consumers show this too. New York Fed survey is a treasure trove of information, comes out every month. What it's showing us is now even the highest income level is expecting their income to grow less than inflation at a rate lower than inflation. Real income deflating even at the top level, let alone at the bottom part of the ladder of income, where you're talking 2 to 2.5% real deflation in income. So you can't support spending at the same time when credit card debt's greater than savings, the highest ever, borrowed at the highest interest rates ever, and delinquency rates are back to the second highest level in history, the last time we saw them here, 2008, 2009. So the Fed will be forced to cut rates to support the consumer, to support the housing market, to support the labor market. The only reason the unemployment rate hasn't risen is because more people are dropping out than are finding jobs. Okay, so this is a problem. It's just a secular structural issue here with the labor market. So, and you still see even with this, wages relative to inflation below 1%, pretty much across the board. So you have a choking consumer, you have a housing market in crisis, you have a labor market that's not as strong as everyone says it is, and the Fed is still restrictive. So they could easily come down to 3.5 just to get neutral against the 3% inflation. If they wait too long and inflation starts to rise, it's going to make it much more difficult for them to do what they probably should be doing right now. And if Powell is playing this off because of tariffs, he does have this out. It's a legitimate out for him. But you get the sense that this is more, that this is kind of mano a mano. He's not going to flinch until September. And Fed Governor Waller said, if we wait till September, it'll be too late. And he said these exact words, which I've been saying almost all year long: we'll be behind the curve. And the Fed is.
Well, what does it do to the stock market at this point? I mean, obviously, people have piled money into the stock market. They got high. So on the one hand, maybe they're looking at lower earnings, to support those levels. And especially, as you say, with so many measures pointing to a slower economy. And I appreciate there's a lot of factors involved, but maybe get a quick take on the stock market with that backdrop.
Well, I've pretty much kind of said this all along, that you would see consumer cocoon, then you might see this into credit. If it got into credit, that would be really bad for the economy. And then I said the next thing would be kind of an economic wake-up call, an epiphany, if you will, in the stock market as to what the reality of the underlying economy is. All right, let's look at the service sector. It's still 71% of the economy. The PCE numbers show that people are buying necessities at the expense of spending on services. And service spending at 1.2% annualized for the month of July is well below the 3.6% accelerating service price CPI. So all of this spells like a stagflation economy where inflation is rising let's not forget even service CPI. Okay, the bulk, over 60% of service is CPI X energy, and there's 114 components. Over half of them, over 60% of them, are running at 3% or hotter, 4%, 40% running at 4% or hotter. Service inflation is real and is well above. This, to me, is if the Fed wants to say, here's why we're not, cutting rates, here's why. Because service inflation, 71% of the economy is still double our target rate, all right? And they haven't been below the target rate in any inflation indicator in 52 months. So that whole thing about a 2% target is losing credibility as we speak.
Yes.
So the bottom line for the stock market, though, is an economic reality check for me. And when you look at the momentum here, you can see it. I mean, not only, and I'm not one, I've called some of these real crash moments, like the tech bubble, like 87, even, like post 2008. I mean, we called this. It's pretty easy to see, frankly, kind of like it's becoming easier to see now, too. And I haven't been one that's been saying crash at all. But right now, this market is so what I call bubblicious on any metric that you measure it against history. This is one of the most overextended and stretched markets ever, not only momentum wise, but in all these relative metrics when you talk about earnings per share, all these dynamics that people use to calculate where stocks are. Almost every single one of them is dramatically overdone and historically overdone at a time when the Fed is tight, the consumer's cocooning, the economy is at risk. So, figure it out. It doesn't paint a pretty picture for the equity market. I actually looked at something like NVIDIA, and we talked about this. I did a piece August 25th, it was called Bubblicious, right? And if you look at NVIDIA, this is a clear-cut topping pattern. You have huge ownership. The most recent rally brought all these new people in. And if you turn down much more from here, a lot of these people are going to be losing money on NVIDIA. So, I mean, the technicals here are very sketchy. The leadership is really nowhere to be found. And what do you have? You have what I said at the beginning of the year, in addition to the yield curve and to uranium, would be one of the big plays, be a rotation of Wall Street money, hardcore money that doesn't move a lot, out of the infotech, out of the upside leaders, into the precious metals mining shares. They're printing money right now. You look at Newmont, I said, watch Newmont, because it was kind of a dog at the beginning of the year. I said, if this thing turns around, it will be a sign that this movement has started, because Wall Street money will do what they do, buy the names they know. They're going to buy precious metals, they're going to buy Newmont, first and foremost. And we have seen that now starting, and it's going to be huge. The stock market, take the GXD, for example, the precious metal, the gold mining share ETF, against the infotech S&P XLK is up by 30% over information technology, our mining shares right now. So I think that's going to be a rotation. You'll see more of the same. But I think the overall stock market, at least in the U.S., is very vulnerable here.
But so many good things that you're saying there that are important for people to hear. And again, I'll just allow me to ask you to reiterate a little bit more on, again, a rotation that comes out of those big time winners. You're seeing some fatigue there, but into, and this is what people are going to be interested in hearing, into commodities, but into gold, for example, maybe gold and silver.
Yeah.
Will it extend right into the juniors? Because we've seen fantastic performance out of the sort of the seniors, as you described in forecast going back several months. We've seen that move by the seniors. So do you also look at, as it goes on, to extend right down the sort of income scale, right down the size scale?
I think it has. I think it is. If you really kind of look at it, the juniors move first. I mean, this has kind of been an upside down move. I mean, the big caps didn't move. Okay, Anglo and Barrick and Newmont, particularly the big three is what I call them. They were dogs at the beginning of the year when some of these smaller cap stocks, some of the ones we like to call an option with no time decay and no expiration date. I mean, New Gold, for example, some of these, I could run the list of stocks that we were looking at. And by the way, most of them were Canadian, okay, because you had the Canadian dollar depreciating at the same time. So if you hedge the Canadian dollar, you get a huge profits here in the U.S. on some of these Canadian mining shares that were not the well-known big cap behemoths that we would expect to be leading the way. In fact, the original breakout in this was led by the smaller stocks. Then when you start to see the rotation, this Wall Street money is not going to buy New Gold or a $5 stock. They can't, they're going to push it around too much. They can't. So they're going to buy the names they know. They can justify to whoever they have to answer to, type of thing. And I think where this comes from, when you talk about the rotation, is really the dynamic and the mindset of the average investor here in the U.S., which is now starting to understand, man, that what you see going on with the dollar, with what's going on with global trade, where you're pushing India now even closer
Yeah.
to Russia and China, and how I've talked about since the 2018, since the 2020 speech I did at your World Outlook conference in Vancouver, that this reordering of the world powers that be, it's a natural resource war. It's been going on for 7 years now. And the other side of the world, China, Russia, OPEC, India, South Africa, you throw Brazil into the mix. And that's a pretty powerful dynamic when you talk about the volume and dollar value of global trade. So you're going to push all these countries away from the dollar, at the same time threaten the BRICS. You know that the BRICS unit's in the background being discussed, huge, right?
Mm-hmm.
But at the same time, when people start to see this, and you hear more people, and I know this because these are the questions I'm now getting from people that are way wealthier than I am, way more successful in their own businesses. They've sold their businesses, have their money now, and they're worried. They can't really tangibly tell you why. They can't really, enunciate it, so to speak. But they know, and they feel it, and they feel it is 36 trillion in debt. They can't keep doing what they're doing. You can't push all these countries away from the dollar. This is going to be a potential problem. So what happens? You get the Wall Street, the registered investment advisor, the associated person, all these people that manage people's money, at the top level, who are either going to be passively index invested or try and outperform the market by owning the Mag 7 and the top performing stocks. They're going to start getting questions, and I think this is happening because I'm hearing that in my world already, and have been for a while. Like, okay, we own the Mag 7. How come we don't own any Mag Silver?
Mm-hmm.
It's like, how much precious metals do we have? How do we have no mining shares here? Gold's going through the roof. And I would also add, to make a short answer even longer, that the dynamic around gold is this has been central bank buying. Poland, Brazil, India, China in particular, selling bonds, taking the dollars, buying gold, almost hoarding gold, right? Physical delivery, which has drained the vaults. And now all of a sudden, you have this whole dynamic around the physical market too. It comes into play. This hasn't been speculative. Open interest on the COMEX is only now starting to rise. It hasn't been a rotation of Wall Street money. That's only now just starting. So this whole predicated move to where we are now had nothing to do with the normal things that will drive gold in the future, like the dollar, which hasn't even cracked yet.
It's funny. I just got to share with you from the Canada side. We've been told how bright central bankers are. And, and I'm just sort of laugh, because keep in mind, the Bank of Canada didn't own gold. They sold
Yeah.
all their gold and they never got back in, as
I
you
remember
say.
when they sold their gold.
Yeah, I sort of
Yeah.
choke. Let me ask you about
You and I talked about it when they sold their gold. That was
That's
quite a
right.
while ago. That was back like 1999. Remember the Washington Accord? They said, okay,
Yeah.
we need to stop selling all our central bank gold. So that was a
No.
big day. That was a turning point in 99.
Let me ask, obviously there's huge sovereign debt issues, the talk now, even the UK's in trouble, France is in trouble, et cetera, et cetera. Well, can governments like the US government afford to have interest rates actually go up, on the longer end? I mean, it seems to me they
Yeah.
can't have higher interest expenses. They can't afford what they're doing.
We're already there. I mean, the interest on the U.S. debt's $1 trillion a year
Yeah.
now, and it's right up there with Social Security in terms of expenditures, right? And as a percentage of GDP, and all the ways you can, again, the metrics you can use to measure this kind of thing are pretty much all off the charts. You also have the 30-year bond pressing 5%, right?
Mm-hmm.
Above which you have a lot of room to move. If it gets above there, we know the amount of debt that they have to refund and sell is astronomical, especially in the next, still 18 to 24 months. So I have said that, again, the Fed will acquiesce to higher rates of inflation to protect the consumer, to protect the labor market, protect the housing market, but potentially and likely to protect the bond market too. So this is already, it's funny because just a few weeks ago, all of a sudden, the talk in the U.S. was YCC, yield curve control,
Yeah.
Japanese style. It's like, okay, well, yeah, of course you can do that. Absolutely can do that. Because if you remember 2006, in my book, Monetary Armageddon, what does that mean? Hey, you got the Fed chief and the Treasury chief in the monetary bunker. They have the keys. They're going to turn at the same time and print enough money to buy every bond ever sold. Right?
Mm-hmm.
Now, that's not the way it's going to happen. It's going to happen over time. So, yeah, if you get an interest rate problem, then the Fed would theoretically become the buyer last resort because it would have to be the buyer last resort. You've pushed a lot of the buyers away, right? We're the world's largest debtor nation, and we continue to antagonize our biggest customers when it comes to our debt. It's kind of silly when you think about it
Yeah.
that way. Who owns the debt? The public. It's like this is public borrowing from ourselves We're going to pay ourselves back with a devalued currency, and we'll probably never get our money back. I mean, if you were running this as a private corporation, you'd be in jail for running a Ponzi scheme.
Mm-hmm.
So, understanding that governments are different and this is the way it works, but when you cut to the chase, this is all on us. And, the real chance to put this behind us and organically grow, right? Keep GDP growing without having to have more and more debt to where now the debt growth has to be higher than GDP just to keep GDP growing. That's the debt black hole that we're in now. The last time to organically fix this was 1990. You had the recession, you had Greenspan, then you even had some budget surpluses under Clinton, but we blew it. Why? Tech bubble. What did we do? Cut rates and the whole 9 yards, started a housing bubble. What was the next thing? QE. And that changed everything, QE in 2008. And now this is the only path. So they will do what they have to do. But staring into that debt deflation abyss, every central banker on the planet will choose to reflate no matter what the cost. And that's the decision we'll be facing soon. And the bond market will certainly be part of the reasons we will make the choices we will make.
Two things that come for me out of that, though, is as it's an old theme of money talks, is I don't want to own anything, even long-term government bonds. I mean, they're the ones in trouble. And the other one is I do want to own gold. And now Bitcoin's been added to that mix for a lot of people. I was always more cautious, although we did recommend it at the World Outlook Conference 2 years ago, strongly recommended it. But it would seem to me that's the logical outcome. I'm talking now for individual investors. I'm just on about you got to get protected here.
Yeah. Well, crypto has a place in this, and it's for reasons that I don't hear a lot of people talk about. I mean, you could bash Bitcoin all you want, and you could say that it's one of the biggest pump and dump schemes of all time, and it may turn out to be that, in fact. But the reality is that Bitcoin, remember, they didn't want to be gold or they didn't want to be the dollar. They wanted to be something new. So what they do? They chose their logo will be a gold coin with a $B sign.
Mm-hmm.
So that was almost fraudulent from the beginning, right? And then they said they don't want to be regulated, right? Well, a few people got ripped off, and all of a sudden, call for regulation. Then they said we don't want to be mainstream. Well, what was the thing needed to propel us to the next move higher? Was ETFs and becoming mainstream, becoming a stock. Okay, So now you have totally financialized Bitcoin to the degree where, yes, there's less and less Bitcoins, but what you have seen is the people now that own this in ETFs, it's the dark pools and the mining, the people that mine this, that used to own over, close to 88, 89% of the supply. That's now, from what I understand, and I'm not an expert on this, but down to 76% because they have started to unload their holdings. Yeah. So that's interesting to me. Having said that, something like Ethereum to me is very interesting. There are some of these things, and here's the reason why, even Bitcoin and, fractal Bitcoin and however you can necessarily potentially buy Bitcoin, all right, is because if you're, say, in a currency, you're in a place like Nigeria or Pakistan or some of these other places, you don't have a pawn shop, you don't have somewhere you're going to buy gold, you don't have somewhere you're going to hold gold, all right? If you hold gold, everyone's going to rip you off, but you might have a phone, you can have a wallet, you can buy crypto. So you look at all the places where currencies are being devalued that could potentially plug into the crypto world. To me, that's the ultimate way that this could really explode into something much, much bigger. I mean, that kind of use basically requires a series of crises to kind of make that happen. I also would say, and this is something I always say that's, seems simple and seems almost stupid, but it's really kind of almost, really prophetic if you think about it, all right? One of the reasons to hold these things is for safety in unusual events, whether it be a weather, a war, whatever it might be. But one of those events with a high probability of happening at some point in the not too distant future, at least, is a coronal mass ejection, a sunstorm, right? And what happens is that could knock out the electrical grid. What good is your Bitcoin in terms of acquiring food if you have no electricity, right? The phones aren't working. So this is, to me, why it's this whole war between should we own this or this? No, own some of both.
Yeah.
I mean, so I think, and in terms of, it's like, hey, do I believe in Bitcoin longer term? I believe it's a giant pump and dump scheme, but it gives you the opportunity here through the next few stages to make a lot of money. So that's what we do here. We take advantage of these mismarked or mispriced or misunderstood markets. Sometimes, not always what we do, but oftentimes when we see that advantage, we try and grab it.
Greg, tell me how people can get more of your stuff, more of Greg Weldon's analysis.
Sure. We just did a big special too on all the gold mining shares.
Yeah.
And what's funny is what we should really do, Mike, is you and I together, okay, should put on some really nice helmets, get into these race cars and do some burnouts and take a victory lap. I mean, seriously, because the the most satisfying thing for me, we're old enough. We've been through the business. I've been through the wars, in the trenches. I'm still in the trenches because I love it, and you make enough money and everything. But when you start to really just the mission statement was to help as many people as you can with what you think is going to happen, right?
Yeah.
And when I get emails now from a client who is really satisfied with what we've done and we've really helped them, and they're so sincere and they're so nice and so humble, that is what really makes me feel good, and that's what humbles me. So at that point, I will just say too, we just did the most recent update on this, which again is kind of like, it's not going to be anything new in there. There's nothing new really to buy here right now in the precious metals. You either own them or you're sitting here watching. If you remember at the beginning of the year, I said, this will turn out to be the kind of market people end up chasing higher. And that's where you kind of are now. So the potential here to get in with us day to day is to see when the next buying opportunity might come. That would be helpful, I think. So you can email me at Greg Weldon at weldononline.com. That's GregWeldon. And you get a sample of the research. We'll put you on a nice little free trial. I know a lot of your people have tried us before. We also, of course, are managing money now. We're not always open to new business. Right now, we are for accredited investors only. I can just say we're hitting out of the park right now. So
I know.
I can't really discuss the numbers on air, so to speak. We can have a private conversation. See if you're a fit for us and we're a fit for you, because it's not just for anyone. We have a high minimum, but that's because right now one gold contract in the futures market is all regulated futures, is all we trade, is worth $360,000. It was worth $100,000 3 years ago. So what the hell? But you can get information on that as well with the money management program in your own name. There's no commingling of funds with anyone. You get a report every single day from the broker telling you what we are. You can email me for that too. And I would also say follow me on Twitter at Weldon Live. Look for our podcast, Money Markets and New Age Investing. You can find it anywhere now. It's on places where we don't even put it right now. It's getting some traction. So Money Markets and New Age Investing. Check out my podcast.
And we'll put all of that in our social media and our Twitter account also. Tell you where you can contact Greg and hear more of his stuff. In the meantime, Greg, as always, I can't tell you how fortunate I am to have been able to visit with you. Not that you don't look this old, but I do, for decades, literally for decades. And as I said, right at the stop of things, I found him because he was the guy so many other analysts were referring their work to, because he had done the work, had a geopolitical approach when it was obviously necessary, but not common, looking around the world. Greg, thanks for finding time. Appreciate it.
My pleasure, Michael. You've done a great job all these years too. So my kudos and my heart out to you, buddy. And keep on rocking, babe.
Appreciate it.